It's the latest sign that the private credit world could be facing a reckoning. Joining us now is Dan Rasmussen. He is founder and portfolio manager at Verdad Advisors. Dan, where do you come in?
This is the start of a big crisis. Rapid growth in lending never ends well. The private credit market was the darling of investors for about 15 years, about $2 trillion or so of new inflows, all went into very risky lending. This lending was generally done at 500 basis points spread over SOFR, and it was done to companies, primarily leveraged buyouts that were taking on 5-6 turns of EBITDA in terms of debt. Those are single B rated securities. Single B rated securities have a 20% 5-year default rate according to Moody's. Remember, liquidity flowing in concealed all these problems on the way up, but now that liquidity is flowing out, we're going to see who's swimming naked.
So yeah, I got a few risks here for sure, but I'm confident in this stock for the theoretical reasons I'm buying it. My biggest concern is the stalled dividend growth rate, which, left unchanged, will eventually limit future payouts, causing me to rotate out of the holding. But as I tend to think in 3, 5, and 10-year blocks of time, ARC has the latitude to establish a place in my portfolio. Also, I consider it a quality company with solid fundamentals, excellent management, and an intelligent approach to their business. My plan is to start a solid seed position on it and let it mostly organically build itself from there by reinvesting its dividends. I chose a seed position of $15,000 for ARC and executed on it a couple of weeks ago. Since my cost basis per share is $17.77, I'll continue to dollar cost average into it. If it dips or crashes, who knows in this market? We've got a lot going on. And I'll also keep dollar cost averaging in if it rises, at least until it gets all the way up to around the fair market value. At that point, I'll adhere to the established method I use in all of my portfolios, where as any holding starts to approach its fair market value, I'll just stop the dollar cost averaging into it. If it pays a dividend and the price continues to appreciate much beyond that, I'll kill the dividend reinvestment and divert that liquid also into something that's a good stock but that has a suppressed price, or is a core holding that doesn't pay a dividend but is also at a fair price. The bottom line is I want to be buying my stuff at a fair price.